Stop the life insurance tax trap that steals 30% of your retirement savings. Cash out the wrong way, and 30% of your life insurance cash value can vanish to taxes in one move. The worst part, it happens when you think you're simplifying. Decades of premiums can turn into ordinary income overnight if you miss one rule. I'll show you how this tax actually works, the traps that trigger it, and the legal ways seniors reduce or avoid it. We'll cover basis first withdrawals, policy loans, the Lapse-With-Loan tax bomb, 1035 exchanges, and IRMAA surprises that raise Medicare premiums 2 years later. Let's start with the core mechanics so you can see your real risk and how to stop it. How cash value life insurance is taxed, the core mechanics. Here's the plain English foundation. Your policy has a few numbers that matter for taxes: your basis, your cash value, your surrender value, and any loans. Basis is the total of premiums you've paid, adjusted for things like dividends you took in cash or reductions from certain withdrawals. Cash value is what's accumulated inside the policy. Surrender value is the cash value minus any surrender charges. Loans are money you've borrowed from the policy, usually secured by the cash value. The thing most people miss is how gains are taxed. Gains are simply what you get out minus your basis. When those gains are recognized, they're taxed as ordinary income, not capital gains. That's why the tax hit can feel so big. There's no lower capital gains rate on these policy gains when you surrender or trigger a taxable event. Now, before we continue, you need to understand the difference between non-MEC and MEC. A non-MEC is a policy that wasn't overfunded according to IRS rules. With a non-MEC, the tax rule is FIFO, first in, first out. That means withdrawals come out of basis first. So if your basis is $80,000 and your cash value is $110,000, the first $80,000 you withdraw is generally tax-free. Only amounts beyond basis are taxable. This next part separates beginners from pros. MEC status flips the order. A MEC, modified endowment contract, happens when a policy is funded too aggressively. With a MEC, it's LIFO, last in, first out. That means gains come out first. So withdrawals from a MEC are taxable up to the gain. And if you're under 59 and a half, there's typically a 10% penalty on top. Many seniors are over 59 and a half, so the penalty may not apply, but the ordinary income tax still does. If you remember nothing else, remember that MEC status changes the withdrawal order and can cause surprise taxes. Let me show you exactly how loans fit. Loans are generally tax-free while the policy stays in force because you're borrowing against the cash value, not withdrawing it. The reason this works is the loan is an income. It's debt secured by the policy. But here's where most people mess up. If the policy lapses or is surrendered with a loan outstanding, the IRS treats the loan balance as if you got that money out. That can create taxable income up to the gain in the policy, what many advisors call the Lapse-With-Loan tax bomb. You didn't get a check at lapse, but you can still owe taxes as if you did. Dividends create confusion too. On participating whole life, dividends are generally treated as a return of premium until you've recovered your basis. After that, dividends are taxable. If you use dividends to buy paid-up additions, you're increasing basis differently than if you take dividends in cash. The insurer's statements should show how dividends were used and how your basis was adjusted. Actually, let me back up and clarify basis tracking. Your insurer should keep a record of total premiums paid, dividends taken in cash, withdrawals, and loans. But records get lost, policies get moved, and demutualization events, when a mutual insurer converted to a stock company and gave policyholders stock or cash, can affect basis. If you received stock in a demutualization, there can be basis allocation questions between the policy and the stock. Get the original demutualization letter and any tax documents to correctly adjust basis. This is why pulling a complete policy history matters before you touch anything. Now, once you nail the mechanics, everything else clicks. For non-MEC policies, a common strategy is withdraw to basis first, no tax, then use loans for additional access. But even with loans, you've got to manage interest and avoid letting the policy run on fumes. Rising loan balances, lower credited interest, or increasing costs of insurance can push a policy toward lapse. And that's exactly when the tax bomb can go off. Cost of insurance and policy charges matter, especially with universal life and variable universal life. If charges rise with age and credited interest lags, cash value can erode. That can force you to add premiums or reduce the death benefit to keep the policy in force. An in-force illustration from the insurer shows you how the policy behaves under different assumptions. Loan rates, crediting, rates, market performance for variable policies, and ongoing costs. Use that to stress test sustainability so you don't stumble into a taxable lapse. One more nuance: surrender charges. If you surrender during a surrender period, the payout may be reduced by those charges. For tax purposes, your taxable gain is typically based on what you receive plus any outstanding loan minus your basis. The surrender charge lowers what you receive, but doesn't usually reduce your gain dollar for dollar like basis does. That's why surrendering at the wrong time can feel like a double whammy: less cash to you and ordinary income on the gain. The quick win today: confirm whether your policy is a MEC, verify your current basis from the insurer, and request an in-force illustration with and without loans. With those 3 data points, you'll see your exposure and avoid triggering accidental taxes. The tax bomb triggers seniors Mississippi. Now, here's where most people mess up: the Lapse-With-Loan surprise. You borrow over the years, the loan grows, interest accrues, and the cash value struggles to keep up. Then a premium gets missed or charges spike, and the policy lapses. The IRS treats the outstanding loan like you took a withdrawal the day the policy died. If there's gain, cash value plus the loan minus your basis, that amount is ordinary income. You don't get a check, but you can still get a 1099 and owe tax. That's the tax bomb, avoidable with a few proactive safeguards. Seniors often trigger this while simplifying. They surrender a policy to tidy up accounts or free up cash, but they don't confirm basis, MEC status, or loan balances first. If the policy is non-MEC, withdrawals up to basis could have been tax-free, but a full surrender recognizes the gain all at once. And if there's a loan, surrender accelerates the recognition too. The result is a big spike in income in 1 year, which can also push up Medicare IRMAA 2 years later. The fix is simple: map your basis and loan first, then decide how to access value. Reduced, paid up, and partial withdrawals can be smart, but here's the catch: crossing your basis turns on taxation immediately. People assume partial equals small tax. Not necessarily. On a non-MEC, you're fine until you pass basis. On a MEC, even a tiny withdrawal can be fully taxable up to the gain. The trick is to confirm your remaining basis before you take a dime, then structure withdrawals to stop right before basis is exhausted, and use loans after that if keeping the policy. Missed premiums within 60 days cause another silent trigger. Many universal life contracts have grace periods. If you miss a notice or two, the policy can enter a short window where it'll lapse unless you pay a specific amount by a deadline. Life gets busy, mail gets buried, the date passes, and the policy lapses. With a loan outstanding, that lapse becomes a taxable event. Set auto pay, email alerts, and calendar reminders. Ask the insurer to send lapse warnings by multiple channels. Don't rely on a single envelope in the mailbox. Demutualization adds to confusion. If your mutual insurer converted to a stock company and you received stock or cash, basis calculations get tricky. Some folks overstate taxable gain because they don't adjust basis for dividends treated as return of premium or for demutualization allocations. If you received shares, the stock basis is usually separate from the policy basis. Mixing them can distort your numbers. The move here is to retrieve the demutualization letter and any 1099s, then have your CPA confirm the correct basis adjustments. Let me give you a quick micro story. A client in her late 70s had a universal life policy with a modest loan, about $24,000. She paid premiums for decades, basis roughly $95,000, cash value around $120,000. She missed 2 notices during a hospital stay. The policy lapsed. The insurer issued a 1099 for the gain tied to the outstanding loan and remaining value. Her taxable income jumped right on top of Social Security and IRA withdrawals, which not only created a tax bill but pushed her into a higher IRMAA bracket 2 years later. The difference maker? She didn't have alerts or a standing instruction to cover shortfalls. We appealed the timing on IRMAA using the life-changing event rules the next year, but the tax year was already locked. If she'd had a small emergency premium paid or reduced face amount earlier, the lapse wouldn't have happened. Another trap is relying on illustrations from years ago. Interest crediting falls, cost of insurance rises with age, and variable subaccounts can dip. What looked fine 5 years back may be on the edge today. If you've been taking loans, compounding loan interest can accelerate the slide. The practical move is an annual in-force illustration with a worst reasonable scenario, lower crediting, higher loan rate, current charges. If the projection shows a lapse in the next 3 to 5 years, act now. Pay interest, reduce face, switch to reduced paid up, or consider a 1035. Also, beware beneficiary changes and ownership shifts done casually. A transfer for value can turn death proceeds taxable to the transferee unless an exception applies. While that's a death claim issue, it intersects with surrender planning. If you're thinking about selling the policy or transferring it to a new owner before a life settlement review, get advice first so you don't accidentally taint the income tax-free nature of the death benefit. Finally, timing matters for year-end moves. If you're going to surrender, a December surrender can bunch income and trigger IRMAA later. Sometimes waiting until January is smarter after modeling with your CPA. Or better yet, defer with a 1035 if it aligns with your goals. The practical takeaway: don't take actions that force all the gain into 1 year without running the numbers. Policy types and what changes tax treatment. Before we run numbers, you need to know how different policies behave because the tax rules meet the product design in messy ways. Think of it as the same tax code, but different engines under the hood. Whole life first. Cash value grows at a declared dividend scale on top of guaranteed interest. It's boring in a good way. Steady, less volatile. Dividends are generally a return of premium until basis is recovered, then taxable. Many whole life owners use dividends to buy paid-up additions, which increases both cash value and basis in a predictable path. The risk here is usually not market swings. It's rising policy loan interest versus credited rates. If loan rates outpace what the policy credits for too long, loans can snowball toward lapse. For taxes, the big trigger is still lapse with a loan or crossing basis with withdrawals. Now, universal life. UL credits interest at a rate the insurer declares, and costs of insurance ramp with age. If credited rates drop or costs rise, your cash value can erode faster than you expect. Indexed UL credits based on an index formula with caps and participation rates. Variable UL invests in market subaccounts, so it can swing up or down. The tax rules, FIFO for non-MEC, LIFO for MEC, still apply, but UL's flexibility creates more ways to accidentally lapse. Missed premiums, underfunding, loans growing while crediting lags. That's why Enforce illustrations matter more here. The same tax bomb exists, but the fuse is shorter in down markets or low crediting periods. Variable UL adds market risk. Gains and losses flow with the subaccounts. If markets fall, cash value can drop while monthly costs keep coming out. That increases lapse risk and shortens the runway if you're carrying loans. Tax-wise, gains are recognized when you surrender or lapse. There's no capital gains rate on those policy gains. They're ordinary income. However, within VUL subaccounts, you're not taxed annually like a brokerage account. Tax is deferred until a taxable event at the policy level. That's a benefit, but it can hide risk until the day you act. Let's talk MEC status because it overrules withdrawal order. Funding too fast, exceeding the 7-pay limits, turns a policy into a modified endowment contract. MEC status sticks. You can't un-MEC a policy by waiting. With a MEC, withdrawals and loans are taxed LIFO up to gain, and pre-5/9 1/2 distributions carry a 10% penalty like an annuity. Most seniors are past that age, but the LIFO taxation still bites. Loans on a MEC don't save you from current taxation. They're treated like withdrawals. For many, that alone changes the access plan. Either avoid distributions altogether, do a 1035 exchange to a more suitable contract, or coordinate withdrawals with medical deductions to offset income. A quick word on Section 7702 and corridor rules. These define how policies qualify as life insurance for tax purposes and set funding limits and death benefit corridors. Recent updates beginning in 2021 changed interest rate assumptions used in testing, which impacts how much premium can go in before MECing and how cash value is designed. The practical takeaway: newer policies can be structured with more flexible funding without tripping MEC as easily, but you still need confirmation of status from the insurer before touching cash. Riders change access and sometimes taxation. Long-term care and chronic illness riders can allow tax-advantaged accelerations of the death benefit if you meet the rider's criteria. Those accelerations are different from loans or withdrawals. They're generally designed to be income tax-free up to limits when qualified. Return of premium riders or overloan protection riders can help manage lapse risk late in life, but they come with rules and potential charges. The thing most people miss is rider triggers aren't automatic. You often need physician certification or to satisfy ADL limitations and benefit caps apply. Illustration versus reality is where plans fail. UL and IUL illustrations assume crediting rates and loan arbitrage that may not materialize. VUL assumes investment returns that can go sideways. Whole life assumes a dividend scale that can change. The reason this matters for taxes is simple. If reality underperforms, loans or withdrawals that looked safe can push the policy toward lapse, turning a tax-deferred asset into immediate ordinary income. Annual checkups let you adjust before the tax bill appears. So here's the shortcut nobody teaches. Match the policy type to your access method. Whole life, favor withdraw to basis and conservative loans. Consider reduced, paid up to cut costs. UL/IUL, monitor crediting and costs closely. Reduce face to stabilize, keep loan to value modest. VUL, treat loans with extra caution. De-risk subaccounts if you'll borrow. MEC, lean toward 1035 exchanges or plan distributions with deductions. Once you align the engine with the road you're driving, your tax risk drops fast. Quick math. Estimate your tax hit before you touch the policy. Let's run the numbers so you can see the size of the tax before you make a move. Grab 4 figures. Total premiums paid to date. That's your basis. Current cash value. Any surrender charge today. And your outstanding loan balance, including accrued interest. If you don't have them, ask the insurer for an in-force illustration and a basis confirmation letter. Now, compute potential gain 2 ways, because timing matters. For a surrender today, take cash value plus any outstanding loan. Then subtract your basis. That result is ordinary income. Surrender charges usually reduce your check, but they don't reduce the taxable gain like basis does. So don't count on them for tax relief. For a lapse scenario, use projected cash value at lapse plus the loan minus your basis. That's the tax bomb amount. Seeing both numbers side by side tells you how bad an unplanned lapse could be relative to a controlled surrender or a deferral move. Next, stack that income on top of your other income. List your Social Security that's already taxable, pensions, IRA withdrawals or RMDs, dividends, interest, everything that hits adjusted gross income. Add the life insurance gain on top, because that's how the tax code treats it. Last dollar and gets your highest marginal rate. This is where seniors get surprised. The extra income can push more of your Social Security into taxation and nudge you into higher brackets. A $40,000 policy gain doesn't just get taxed by itself. It can cause collateral taxation around it. Now, flag Medicare, IRMAA. Medicare uses your modified adjusted gross income from 2 years prior to set Part B and Part D premiums. If this surrender or lapse spikes your magi this year, your premiums can jump in 2 years. That's a real cash cost. So look up the current IRMAA brackets, see where your projected magi lands with and without the policy gain, and note which side of the line you fall on. Sometimes splitting income across years or deferring with a 1035 exchange keeps you under a threshold. Don't forget your state. Some states tax this income, some don't, and some have different brackets that kick in earlier. Check your state's treatment of life insurance surrenders and ordinary income. A 5% state tax on a $50,000 gain is $2,500, worth planning around. Let's do a quick stress test. Scenario A, you surrender now. Income equals cash value plus loan minus basis. You pay tax this year. Scenario B, you keep it but don't add premium and crediting underperforms. Project when it lapses and calculate the taxable gain at that point. If the lapse year gain is bigger, or if it lands in a year, you'll also have a large RMD. You've got a double stack. Scenario C, you withdraw only to basis this year on a non-MEC, then pivot to loans. That creates no current tax, but you must model sustainability to avoid a later lapse. Scenario D, you 1035 exchange to an annuity or new life contract and defer the gain entirely, resetting surrender periods, but keeping the IRS at bay for now. Here's a simple worksheet flow. Step 1, basis confirmed, write the number. Step 2, cash value, surrender charge, loan balance, write all three. Step 3, gain if surrendered today, cash value plus loan minus basis. Step 4, projected lapse gain next year, projected cash value plus loan minus basis. Step 5, add the gain to your existing income and check federal brackets. Step 6, check IRMAA thresholds with and without the gain. Step 7, add state tax where applicable. Step 8, note which scenario gives the lowest combined tax plus IRMAA cost over 2 years. 2 quick mistakes to avoid. 1, using old basis numbers. Dividends taken in cash, prior withdrawals, and certain adjustments reduce basis. Verify it. 2, ignoring the loan interest accrual. Loans grow monthly. Waiting 3 months can increase taxable income if you're approaching surrender or lapse. Your quick win today. Run these numbers on paper, even rough, before you touch the policy. If the tax hit looks large or IRMAA risk shows up, you've just saved yourself from an expensive surprise and earned time to choose a smarter path. Safer options, 1035 exchanges to defer taxes. If your quick math showed a big gain, here's the safety valve, a 1035 exchange. It's the IRS-approved way to move from one policy to another or to an annuity without recognizing the gain today. The reason this works is simple. You're not cashing out, you're swapping contracts. Your basis and your unrealized gain carry over to the new contract, so you defer the ordinary income tax that a surrender would trigger. What qualifies? Life-to-life is allowed, and life-to-annuity is allowed. Annuity-to-annuity is allowed too. What's not allowed is annuity-to-life. If your current policy is a non-MEC, it remains non-MEC if you 1035 into another life policy with equivalent funding, but funding and design can still MEC the new one, so you need confirmation. If your current policy is a MEC, MEC status carries over to the new life policy. Moving a life MEC to an annuity keeps it taxable, like an annuity going forward, so plan distributions accordingly. Partial versus full exchanges come up a lot. A full exchange moves the entire contract value. A partial exchange moves a slice. Sounds neat, but there's a trap. The IRS looks at aggregation rules and anti-abuse provisions. If you do a partial exchange and then take withdrawals within a short window, the IRS can recharacterize it in ways that defeat deferral. Work with your CPA to set the sequence and timing so basis and gain are preserved correctly. Now, match the exchange to your goal. If you want simpler, lower costs, and controlled withdrawals, a 1035 from life to a low-cost annuity can work. You'll defer the gain today, and then take annuity withdrawals later, taxable to the extent of gain under the annuity's LIFO rules. If you need better living benefits, you might 1035 to a new life policy with a strong chronic illness or LTC rider. Some people use a 1035 to a life/LTC hybrid or an annuity/LTC hybrid to convert dormant cash value into tax-advantaged LTC benefits under the rider's rules. There are pitfalls. MEC status can follow you, as I said, and that changes how you can access money later. A new policy often restarts surrender periods, so you'll face fresh surrender charges if you change your mind soon. Underwriting matters for life-to-life. You must qualify medically unless you're using guaranteed issue options with trade-offs. You might also lose legacy guarantees from an older contract. That's why you ask for side-by-side Unforced illustrations and new policy ledgers to compare costs, guarantees, riders, and sustainability before you sign. Paperwork precision is everything. You don't take a check and then deposit it. That breaks the 1035 chain. You do a direct transfer, insurer to insurer, trustee to trustee. You'll need your current contract number, the owner's name and tax ID, the current basis confirmed by the existing insurer, and the receiving company's 1035 packet. Ask the current insurer for a basis confirmation letter and loan status. If there's a loan, you have choices. Repay it before the exchange, carry it if the new policy accepts it, or do a loan extinguishment strategy that doesn't trigger gain. Only certain carriers handle that cleanly. If the loan is discharged as part of the exchange in a way that's treated like you received value, you can accidentally create taxable income. So you want the carrier's written representation on loan treatment. For annuity targets, clarify whether you want immediate income later or accumulation with flexible withdrawals. Fixed annuities offer simplicity. Fixed indexed annuities add index-linked crediting. Variable annuities add market exposure with fees. Your carried-over basis will offset future taxation dollar for dollar until basis is recovered, and then withdrawals become taxable. Coordinate with your RMDs if the annuity goes inside an IRA, though a 1035 is a non-qualified transfer, so you typically stay in the non-qualified world. Here's a quick checklist to make this real. 1. Confirm MEC status and basis in writing from your current insurer. 2. Choose the destination, life with better riders or lower costs, or annuity for controlled taxation. 3. Run tax modeling with your CPA, including IRMAA projections with and without the exchange. 4. Review surrender schedules and guarantees side by side. 5. Execute a direct 1035 transfer, no checks to you. 6. Verify completion and basis carryover on the first statement from the new contract. A micro win you can do today. Call your insurer and request a 1035 exchange packet and a basis letter. That single call buys you time and options, because once you hold those documents, you can shop destinations without risking a taxable surrender, using policy loans and withdrawals without triggering taxes. Let's turn mechanics into a practical access plan. If your policy is a non-MEC, the clean play is simple: withdraw to basis first, then switch to loans. That sequence lets you tap cash value with no current tax up to your cost basis, and then borrow against the rest while the policy stays in force. The key is precision. Know your remaining basis to the dollar and stop withdrawals before you cross it. Here's the workflow most people skip. Step 1, get a basis confirmation letter from the insurer. Step 2, request a partial surrender or withdrawal specifically capped at your remaining basis. Step 3, after the insurer confirms your remaining basis is zero, use policy loans for any extra cash you need. Done right, you've avoided recognizing gain this year and kept the tax deferral intact. Now, loans aren't set and forget. Loan interest accrues, usually annually but calculated daily. If loan rates rise or credited interest falls, the spread can turn negative and your cash value can erode. Put guardrails in place. Ask for automatic loan interest payments from your bank each year, not from the policy. Set alerts for when your loan-to-cash value ratio crosses a threshold, say 40% or 50%, depending on policy type. And calendar an annual check-in to compare loan rate, crediting rate, and cash value trend. The thing most people miss is how Unforced illustrations become your GPS. Ask the insurer for 3 runs: current assumptions, a conservative crediting scenario, and a higher loan rate scenario. On each, check 3 items: projected lapse year, required premium to keep the policy in force to age 95 or 100, and death benefit trajectory. If any run shows a lapse inside your lifetime, adjust now, pay loan interest out of pocket, reduce the death benefit, or switch to reduced paid up if available. Reducing the face amount is a quiet win. Lower face means lower monthly charges, which gives your cash value more room to breathe while you carry a loan. Many universal life policies let you process a face reduction without new underwriting. For whole life, ask about a reduced paid-up election. That stops premiums, drops the death benefit to a paid-up level, and cuts internal costs. Your cash value stays, dividends may continue, and loan pressure eases. It's not flashy, but it lowers lapse risk, the enemy of tax planning. Automatic premium loans are another tool, but use them intentionally. On some whole life contracts, if you miss a premium, the company will automatically create a loan to pay it. That keeps the policy in force, which avoids the tax bomb, but it also grows the loan. If you enable this, pair it with a standing order to repay those auto loans quarterly so they don't compound. For MECs, the rules change. Withdrawals and loans are treated LIFO, so they're taxable up to gain. If you must pull cash from a MEC, coordinate with your CPA to offset income, bunch deductible medical expenses in the same year, or tie it to long-term care costs you can itemize. Better yet, consider a 1035 exchange to a contract that matches your goals. Then plan distributions thoughtfully. Loans from a MEC don't magically avoid tax. Treat them like withdrawals for planning. Common mistakes to avoid make or break this strategy. First, overloaning, taking the maximum loan the illustration shows without a cushion. Markets fall, crediting shifts, and your safety margin evaporates. Keep a buffer of unborrowed cash value. Second, ignoring small notices. A single grace period letter can be the only warning before lapse. Opt into email, text, and paper alerts. Third, not tracking MEC status after changes. A material change or face reduction can trigger new 7-pay testing. Confirm status in writing after any modification. Let me give you a quick win you can do today. Call the insurer and ask for your current basis, current loan balance with accrued interest, loan interest rate, credited rate, and an in-force illustration showing a reduced face amount option and a reduced paid-up option if applicable. With that one call, you'll know your safe withdrawal amount, your loan risk, and your best lever to cut costs. If the goal is steady income, set up a basis to loan strip. For example, over the next 6 months, withdraw equal amounts up to your remaining basis. Then switch to small, scheduled loans quarterly, not annually, so you can monitor and adjust. Recalculate annually. If loan interest surpasses crediting for 2 reviews in a row, throttle back or repay a portion of the loan to rebalance. This rhythm gives you control and keeps taxes off the table while the policy remains healthy. Funding care, tax-smart ways to use life insurance. If your goal is paying for care, you've got more options than surrender and pay tax. Let's line them up from keep the policy to exit the policy, and I'll show you when each one makes sense. Start with long-term care and chronic illness riders. These riders let you accelerate part of the death benefit while you're alive if you meet the rider's triggers, usually help with 2 activities of daily living or severe cognitive impairment for LTC, or a physician certification for chronic illness. The reason these can be powerful is the acceleration itself is designed to be income tax-free up to limits because you're not taking a withdrawal or a loan, you're accessing the death benefit. Ask your insurer for the rider's eligibility rules, benefit caps, elimination periods, and whether payments are indemnity or reimbursement. If it's indemnity, you receive a fixed monthly benefit. If it's reimbursement, you submit expenses. Either way, this route prioritizes care funding without creating ordinary income. If your policy has no rider or the benefits are too thin, consider a Viatical settlement in the narrow situations where it fits. A Viatical applies when the insured is terminally ill or, in some cases, chronically ill under specific definitions. When it qualifies, proceeds to the seller can be income tax-free under the Viatical settlement rules. It's not a first choice, but when the medical criteria are met and care costs are immediate, it can beat surrendering and paying tax on the gain. You'll need documentation from a physician, and you should compare offers from multiple licensed Viatical providers. Life settlements are different. Here, you sell the policy to an investor when you're not terminal. The buyer takes over premiums and collects the death benefit later. Tax treatment is layered. You recover your basis first, tax-free. Amounts over basis up to the surrender value are ordinary income, and any excess above surrender value can be treated as capital gain. That mix can produce a better after-tax result than surrender if the purchase price is strong. The catch is transaction costs and eligibility, face amount, age, and policy type all matter. Get multiple bids, ask for a net of fees offer, and have your CPA model the tax outcome against a surrender and a 1035 exchange. Also review transfer for value rules and ensure exceptions apply if any part of the death benefit is intended to remain tax-free for a beneficiary. A powerful middle path is a 1035 exchange into LTC-capable products. You can 1035 your life policy's cash value into a life/LTC hybrid policy or an annuity with LTC riders. The benefit is twofold. You defer the gain today, and you reposition it into a contract that can deliver tax-advantaged LTC benefits if you qualify later. For annuity/LTC combos, certain qualified LTC payouts from the annuity can be tax-free under the rider rules. For life/LTC hybrids, chronic or LTC accelerations follow the rider's tax treatment. This route works best when underwriting is feasible or when you can use products that require less stringent health screening. Compare benefit pools, monthly caps, elimination periods, inflation options, and how unused benefits revert to death benefit. Now, coordinating with medical deductions can soften taxes if you must take taxable income. If you have a MEC and need cash, Pairing withdrawals with high medical expenses in the same year can help. Out-of-pocket LTC costs, home care, assisted living, or nursing home bills may be deductible if you itemize and exceed the adjusted threshold. That means the taxable distribution gets offset partly by deductions. Timing is everything. Bunch expenses in one year, then take the distribution in that same year rather than spreading both thin across 2 years. Keep receipts, care contracts, and physician statements to substantiate deductions. Don't forget health savings accounts if you still have one from pre-Medicare years. You can't contribute once on Medicare, but you can spend existing HSA dollars tax-free on qualified medical and LTC expenses. That frees up other cash so you don't have to tap the policy this year, avoiding taxable recognition. Also check eligible premiums for qualified LTC insurance. HSAs can pay those up to age-based limits. If the policy will remain in force, consider reduced paid-up or face reductions to lower internal costs while you fund care from other sources. Lowering costs reduces lapse risk while you evaluate riders, settlements, or exchanges. For chronic illness riders already in place, ask the insurer to pre-qualify your claim and outline the documentation so you know exactly how fast funds could arrive if you initiate. Here's a quick decision grid you can use. Rider with adequate benefits available. Use the rider first, tax efficient, and fast once approved. No rider, but severe health qualifying? Compare Viatical versus 1035 to a hybrid. Pick the higher net benefit with acceptable timing. Moderate health, sizable cash value, and no rider? Get life settlement bids model after tax proceeds and compare to 1035 hybrid benefits. MEC with unavoidable taxable need. Time distributions in the same year as large documented medical deductions. One more practical note. IRMAA. Care funding often spikes income inadvertently. If a settlement or surrender will raise magi, see if you can structure it to avoid crossing an IRMAA tier, or prepare a life-changing event appeal if your income drops the following year due to retirement or other qualifying changes. Appeals aren't guaranteed, but they're worth filing when facts support them. Your action step today: list your care goal, then call your insurer to confirm rider availability and eligibility, request a 1035 packet for hybrid options, and, if appropriate, authorize a settlement broker to pre-screen your policy. With 3 phone calls, you'll know your tax-smart path to fund care without walking into a hidden tax bill. Estate and beneficiary planning to avoid unforced errors. If your goal is legacy, small paperwork mistakes can turn into tax or timing headaches for the people you love. Let's lock down the ownership, the beneficiaries, and the rules that keep death benefits clean and efficient. Start with ownership. When you own the policy personally, you control changes, loans, and riders, but the death benefit can be included in your taxable estate if you hold incidents of ownership at death. For most, that's not an immediate federal estate tax problem, but state estate taxes and future thresholds can change the math. Joint ownership sounds simple, but it muddies control and can complicate 1035 exchanges and settlement options. If your spouse is the intended beneficiary and you want clean control, individual ownership with clear beneficiary designations is usually cleaner than joint. Now, incidents of ownership. This is any right to change beneficiaries, borrow, surrender, or pledge the policy. If you keep those rights, the death benefit can be pulled into your estate for estate tax purposes. When estate exposure is likely, an irrevocable life insurance trust. An ILIT can hold ownership, remove incidents of ownership from you, and keep the death benefit outside your estate if structured and funded correctly. The trade-off is control. The trustee runs the policy per the trust terms, and changes require trust formalities. Funding an ILIT with an existing policy usually involves transferring ownership and navigating the 3-year look-back for estate inclusion. A new policy owned by the ILIT avoids the look-back but requires underwriting and proper gift administration for premiums. Let's talk beneficiary design. You need a primary and at least one contingent. If the primary predeceases you or disclaims the benefit, the contingent steps in. Use full legal names and social security numbers where possible to avoid delays. Decide between per stirpes and per capita. Per stirpes passes a deceased child's share to that child's descendants. Per capita reallocates evenly among surviving beneficiaries. If your goal is to keep bloodline shares intact when someone passes prematurely, per stirpes often fits better. If simplicity among living beneficiaries is your priority, per capita can work. Keep designations aligned with real life. After marriage, divorce, births, deaths, or trust updates, file new beneficiary forms. Your will does not override insurance designations, and courts follow what's on the policy. If you're using a trust as beneficiary, make sure the trust exists, has correct titling, and the name matches exactly. Coordinate with your estate attorney so the trust provisions match your goals. Things like special needs, spendthrift protections, or age-based distributions. Death benefit taxes are straightforward most of the time. Life insurance death proceeds are generally income tax-free to the beneficiary. But there's a big exception, the transfer for value rule. If you transfer the policy for something of value, selling it or swapping it to a non-exempt party, the death benefit can lose its income tax-free status, except to the extent of basis. There are exceptions. Transfers to the insured, to a partner of the insured, to a partnership in which the insured is a partner, to a corporation in which the insured is a shareholder or officer, or where the transferee's basis carries over. Before you sell, gift, or restructure ownership, especially if you're exploring a life settlement, have a pro review the transfer for value implications and see if an exception applies. Here's where policy loans sneak into legacy planning. A death with loans outstanding reduces the net benefit your beneficiary receives. That's expected, but if you inadvertently cause a taxable lapse before death, say by missing notices, the policy can terminate, trigger income tax to you, and leave no death benefit to heirs. To protect legacy, add loan monitoring, enable multiple lapse notices, and consider an overloan protection rider where available. Some riders can keep a policy in force at late ages by switching crediting methods, but they have conditions you need to understand ahead of time. Title changes and 1035 exchanges require extra care. If you move a personally owned policy into a trust, document the transfer, confirm MEC status after any material change, and refile beneficiary designations under the new owner. During a 1035 exchange, make sure the new contract lists the correct owner and beneficiaries from day one. A missing contingent or a typo can trigger probate for a portion of proceeds. Always request written confirmation of ownership, beneficiaries, and MEC status after changes. One more nuance: coordination with retirement accounts and charitable goals. If you want to leave tax-heavy assets like IRAs to charity and pass life insurance to family, update your beneficiary mix so the IRA names the charity and the policy names people. That can minimize overall taxes across your estate plan. If you're charitably inclined, some use policies inside trusts to replace wealth donated during life. Documentation wins. Keep a one-page policy profile. Owner, insured, primary and contingent beneficiaries with phone and address, basis to date, loan balance, rider summary, and the insurer's service line. Store it with your estate binder and give copies to your spouse and the trustee or executor. Annual review. Confirm nothing changed and re-sign if you update beneficiaries. Your quick win today. Request a beneficiary confirmation from the insurer, verify per stirpes or per capita language, and schedule a 20-minute call with your estate attorney to review incidents of ownership and whether an ILIT or simple retitling makes sense. 3 small steps, and your legacy plan stops relying on luck. Documentation, cost basis recovery, and fixing missing records. Before you touch the policy, lock down your paperwork. Documentation is what keeps taxes predictable and avoids 1099 surprises. Start by requesting a complete policy history from the insurer. Ask for total premiums paid to date, dividends paid and how applied, partial surrenders or withdrawals with dates and amounts, loan history with current balance and accrued interest, MEC status history, any material changes or face reductions, surrender charge schedule, and a basis confirmation letter. Also request your latest in-force illustration and any prior demutualization notices if the company ever converted from mutual to stock. If your policy moved between carriers, ask each prior insurer or administrator for records during their stewardship. You want a continuous chain of premium and transaction data. When reps hesitate, use specific phrasing. Please provide a transaction-level policy history from issue through today and a written basis confirmation as maintained on your system. Written basis beats a phone estimate every time. Now, reconstruct basis if data's missing. Start with your own files, bank statements, canceled checks, bill pay logs, annual policy statements, and prior tax returns. Many people overlook Schedule A notes or advisor reports that list annual premium totals. Create a timeline spreadsheet with columns for date, premium paid, dividends received, cash or used to buy additions, withdrawals, and adjustments. Add a notes column for clarifying entries, dividends used to purchase paid-up additions, face reduction, loan interest paid out of pocket. Dividends need careful treatment. Dividends are generally a return of premium until basis is recovered. If you took dividends in cash, they typically reduce your remaining basis dollar for dollar. If you used dividends to buy paid-up additions, confirm whether the insurer increases basis for those additions. Your policy statements should show cost basis or taxable gain if surrendered. Don't rely solely on the gain line. Tie it back to premium and dividend records so you understand how it was derived. If you received policyholder dividends during a demutualization period, keep those documents with your basis file. Demutualization requires an extra file. Retrieve the demutualization letter, any share allocation statements, and 1099 forms if you received cash. Keep stock basis documents separate from the policy. Your CPA may allocate some basis to the shares depending on the event specifics, but the practical step is to keep a clear wall between policy basis and stock basis so you don't double count. If the insurer can't produce complete records, pull IRS transcripts to cross-check reported forms. Request wage and income transcripts. For years, you might have received 1099-R, 1099-LTC, or 1099-B tied to the policy or related transactions. You're not looking for premiums. Those aren't reported. You're looking for prior taxable events to reconcile with your history. If you sold demutualization shares, that 1099-B helps you track what happened and when. Build a basis dossier you can hand to any advisor, one binder or digital folder with the insurer's basis confirmation, your transaction spreadsheet, copies of statements, demutualization documents, current in-force illustration, MEC status letter, surrender charge schedule, and a one-page summary. On that summary, list basis to date, cash value, loan balance, MEC status, and known gaps with your best documentation notes. This is your audit trail if the IRS or carrier questions your numbers later. Here's the shortcut nobody teaches. Reconcile 3 numbers every year: insurer reported basis, your spreadsheet basis, and the insurer's projected taxable gain on surrender. If they don't align, find the discrepancy now, not after a 1099 shows up. Ask the carrier to explain any gap in writing so you have an audit trail. Common mistakes to avoid. 1. Assuming automatic basis updates for paid-up additions. Verify in writing. 2. Ignoring loan interest paid from policy values. That reduces cash value and can distort projections. Track it separately. 3. Tossing old statements after a merger. Keep everything until your new carrier issues a written basis confirmation and you've reconciled it. If your records are thin, don't freeze. Document what you can, annotate gaps, and ask the carrier to research archived systems. Some maintain microfilm or legacy extracts on request. Meanwhile, have your CPA help estimate a defensible basis using bank records and consistent premium patterns. Your practical action today: request a full transaction history and basis confirmation, start a simple spreadsheet, and file your demutualization papers in the same folder. With that, you'll control the tax story instead of letting it surprise you. Coordinating with pros, who does what and when. You don't need a dozen meetings, you need the right people in the right order, each doing one clear job. Think of it as a relay: tax modeling, product mechanics, legal guardrails, then execution. Start with your CPA or enrolled agent. Their job is to turn your policy numbers into tax outcomes. Hand them your basis confirmation, current cash value, loan balance, and the scenarios you're considering. Keep with loans, partial withdrawal to basis, full surrender, 1035 to annuity, 1035 to new life with riders, or a settlement offer. Ask for three things: a federal and state tax projection for each scenario, Social Security taxation impacts, and a 2-year IRMAA projection showing which Medicare tier you hit if income spikes. Have them model timing, December versus January, and what changes if you split withdrawals across 2 tax years. Also ask them to map potential medical deductions if you're pairing distributions with care costs. Their deliverable is a 1-page summary: marginal bracket, total tax, IRMAA exposure, and the lowest cost timing. Once the tax lane is clear, bring in a fee-only fiduciary planner, ideally someone who doesn't sell insurance. Their job is to integrate the tax results with your retirement plan. Give them the CPA's summary, your spending needs, RMD schedule, and investment risk tolerance. Ask for a sequencing plan: which accounts to tap first, how a 1035 destination fits, and how policy access affects portfolio withdrawals. Have them test cash flow stability under conservative assumptions, lower crediting, higher loan rates, and flag any risk of a policy lapse that would break the tax plan. They should also check IRMAA buffers across years and recommend whether to throttle income to stay below key thresholds. Their deliverable is a timeline: now 30 days, 60 days, 90 days, and the annual rhythm. Next, the Insurance License Pro. This can be an independent agent or the carrier's advanced markets team. Their job is mechanical: confirm MEC status in writing after any contemplated change, pull Unforced illustrations under current, conservative, and higher loan rate assumptions, and produce side-by-side ledgers for any 1035 targets. If you're exploring life or annuity replacements, they gather full product disclosures, rider details, surrender schedules, and overloan protection terms. If a loan exists, they coordinate loan handling during a 1035, carryover, repay, or carrier-managed extinguishment without taxable income. Their deliverable is documentation: policy ledgers, forms, 1035 packets, and written confirmation of basis carryover and MEC status post-change. If your plan touches ownership, beneficiaries, trusts, or Medicaid planning, loop in an elder law or estate attorney. Their job is risk control. Ask them to review incidents of ownership, recommend whether an ILIT or simple retitling makes sense, and align beneficiary language for STRPs versus per capita, trust naming, and contingents. If you're funding care, have them check Medicaid look-back implications of policy changes, settlements, or transfers, and coordinate spend-down strategies if needed. They also prep a life-changing event IRMAA appeal strategy if your income will fall next year due to retirement, marriage change, or other qualifying events. Their deliverable is updated documents and a memo outlining legal constraints and approvals required before execution. Now, pull it together with a 1-page action plan. At the top, write your goal: reduce tax on exit, fund care, or preserve legacy. Then list roles and dates. Data: you request basis letters, full transaction history, Unforced illustrations. Tax, CPA returns projections with IRMAA analysis and timing advice. Planning, fiduciary sequences withdrawals and sets cash flow guardrails. Insurance, License Pro delivers 1035 options, rider details, and forms. Legal, attorney updates ownership/beneficiaries and confirms trust or Medicaid implications. Add decision gates. Proceed with 1035 only after basis carryover is confirmed in writing. Execute withdrawals only after remaining basis is verified. Enable lapse alerts before any loan increase. File IRMAA appeal within the window if triggered. Finally, schedule check-ins. 30 days after changes. Confirm the new policy's basis and MEC status on the first statement. At 90 days, reconcile projections to reality. Loan balances, crediting rates, charges. Annually, rerun tax and IRMAA buffers, pull fresh illustrations, and re-sign beneficiary confirmations. Keep the team small, keep deliverables in writing, and move in sequence. That's how you avoid accidental taxes and keep control. 5 practical playbooks you can copy. Let's turn all this into ready-made plays you can run. I'll give you 5, each with a clear objective, the moves to make, and the key guardrails so you don't trip a tax wire. Playbook 1, keep and streamline. Goal, preserve death benefit, access cash safely, and avoid the Lapse-With-Loan tax bomb. Moves, confirm MEC status and basis in writing. Withdraw to basis only. Cap the partial surrender at your remaining basis. Then switch to small scheduled loans. Reduce the face amount or elect reduced paid up to cut internal costs so the policy stays healthy. Pay loan interest from your bank annually. Guardrails, run Unforced illustrations at conservative crediting and higher loan rates. If any projection lapses inside your life expectancy, lower loans, or repay a chunk. Enable autopay for premiums and multi-channel lapse alerts. Playbook 2, 1035 to a low-cost annuity. Goal, defer today's ordinary income, then control taxation with a cleaner payout later. Moves, request a direct 1035 exchange from the life policy to a fixed or fixed indexed annuity with transparent fees. Verify basis carryover on the receiving contract's first statement. Decide on an income plan, systematic withdrawals, or a future annuitization, coordinated with your RMDs and tax bracket. Guardrails, confirm whether your current policy is a MEC. MEC status doesn't stop the 1035. But annuity withdrawals are LIFO-taxable up to gain. Model IRMAA with your CPA, so withdrawals don't push you over thresholds. Watch surrender schedules on the annuity. Choose a term that matches your planning horizon. Playbook 3, 1035 to new life with an LTC or chronic illness rider. Goal, convert idle cash value into tax-advantaged care benefits while keeping some death benefit. Moves, pre-qualify health with a License Pro or use simplified issue options. Compare riders. Eligibility, ADLs or cognitive, monthly caps, indemnity versus reimbursement, and inflation options. Execute a direct 1035 to the chosen hybrid. Guardrails, MEC status on the old policy can carry. Confirm the new policy's MEC testing under its funding pattern. Request written confirmation of basis carryover. Underwrite carefully. Don't lapse the old policy until the new one is in force. Check overloan protection or guarantees that keep coverage intact at late ages. Playbook 4, life settlement versus surrender. Run the net of tax comparison. Goal, maximize cash today when you don't need the death benefit. Moves, get multiple bids from licensed settlement providers through a broker who shops the case. Ask for net offers after fees. Hand the top 2 bids to your CPA along with a surrender quote and your basis. They'll model tax. Basis recovered first. Ordinary income up to surrender value. Capital gain above that. Compare the settlement after tax to a 1035 destination's value and to surrender proceeds. Guardrails: review transfer for value implications and confirm an exception applies if needed. Keep the policy in force during bidding. Pay required premiums or arrange premium financing per the broker's process. Verify state regulations and rescission rights. Playbook 5: terminal illness acceleration and rapid estate prep. Goal: fund immediate needs tax efficiently and tighten legacy documents. Moves: if you meet terminal or qualifying chronic illness criteria, request an accelerated death benefit under your policy rider. Those accelerations are generally designed to be income tax-free within limits. In parallel, update beneficiary designations, verify incidents of ownership, and, if appropriate, move to an ILIT or confirm your existing trust is properly named. If the policy lacks a rider and terminal criteria are met, compare a Viatical settlement, which can also be income tax-free when it qualifies. Guardrails: get the physician certification your rider or Viatical provider requires. Confirm how acceleration reduces the remaining death benefit and any liens. Coordinate with your attorney on timing, Medicaid lookback, and estate logistics. Now, how do you pick? Start with your primary goal: income stability, tax deferral, care funding, or immediate cash. Layer on constraints: health for underwriting, loan size, MEC status, and surrender charges. Then apply the quick math you already did, total tax plus IRMAA over 2 years, to each play. The winner is the plan with the lowest combined cost that still meets your cash flow needs and keeps lapse risk low. 2 fast mini plays worth noting. First, the basis bridge. On a non-MEC, spread withdrawals to basis across this year. And next, if it keeps you under an IRMAA tier. Then begin loans. Second, the Lapse Firewall. If you're carrying a large loan, add an overloan protection rider if available, or preemptively reduce face and set auto loan interest payments. It's cheaper than a surprise $10.99. Your micro action today. Circle the playbook that fits your goal. Call the insurer for any missing confirmations, basis, MEC status, loan terms, and book a 20-minute slot with your CPA to model that one play. One decision, one call, one meeting. That's enough to move from risk to control. Common mistakes that trigger taxes and how to avoid them. Let's tighten the bolts on the traps that still catch people, and I'll show you the exact fix for each one. First, letting policies lapse with loans outstanding. This is the biggest tax bomb because the loan is treated like taxable income to the extent there's gain when the policy terminates. The fix: create a lapse firewall. Set multi-channel lapse alerts, pay loan interest from your bank annually, and run an in-force illustration under conservative assumptions. If any scenario shows a lapse inside your lifetime, reduce the face amount or elect reduced paid up now. Add an overloan protection rider if the contract offers it and you qualify. It can keep the policy in force at late ages by switching crediting methods, but understand the trigger conditions before you rely on it. Second, pulling withdrawals past basis on a MEC, or even on a non-MEC because you guessed wrong about basis. On a MEC, distributions and loans are taxed LIFO up to gain, and pre-59 1/2 adds penalties, though most seniors clear that. The fix: stop guessing. Ask the insurer for a basis confirmation in writing, not a phone estimate. On non-MEC policies, explicitly cap partial surrenders to your remaining basis. If you own a MEC and still need cash, coordinate with your CPA to match withdrawals to deductible medical expenses or care costs in the same year. Better yet, consider a 1035 to a product that fits your goals and manage taxation on your terms. Third, ignoring how added income stacks on Social Security and triggers IRMAA. People surrender, think they'll pay their normal bracket, and forget Medicare uses Magi from 2 years earlier. The fix: model before you move. Have your tax pros stack the life insurance gain on top of pensions, RMDs, and dividends, then check current IRMAA tiers. If you're right on a line, delay to January, split income across years. or use a 1035 to defer. If a spike is unavoidable but your income will drop due to retirement or other qualifying events, prep a life-changing event appeal for IRMAA. File it when the time comes with documentation. Fourth, starting a 1035 exchange without confirming basis, MEC status, and loan treatment. This can lead to bad surprises like MEC carryover you didn't anticipate or taxable loan extinguishment if the process isn't handled correctly. The fix: paperwork discipline. Get a written basis letter and MEC status from the current carrier. Confirm in writing how any loan will be handled in the exchange: carried, repaid before transfer, or extinguished without taxable income under the carrier's rules. Execute a direct insurer-to-insurer transfer. After the new contract issues, verify basis, carryover, and MEC status on the first statement. Fifth, failing to monitor policy costs, crediting rates, and loan interest. In UL and IUL, charges rise with age, caps can reset, and loan rates float. In VUL, markets dip and charges keep coming out. The fix: an annual 3-illustration review, current, conservative crediting, and higher loan rate. On each, check projected lapse age, required premium to sustain to age 95 or 100, and death benefit path. If any run lapses early, take action. Cut face amount, switch to reduced paid up, pay interest out of pocket, or partially repay the loan. Sixth, assuming surrender charges reduce taxable gain. They don't. They reduce your net check, not the ordinary income calculation. The fix: compute the gain correctly. Cash value plus outstanding loan minus basis. Use surrender charges only to understand cash in hand, not tax owed. Seventh, mismanaging dividends and paid up additions in basis tracking. Dividends taken in cash typically reduce remaining basis. Dividends used to buy paid up additions can increase basis if the insurer treats them as additional premium. The fix: get the carrier's basis calculation methodology and reconcile it to your records. Keep dividends and PUA transactions on your spreadsheet so your basis stays defensible. Eighth, taking partial withdrawals that look small but cross basis mid-year. People assume small equals safe, then a late year dividend or policy charge adjusts the math. The fix: stage withdrawals. Request the insurer cap each partial to the then current remaining basis and reconfirm basis before any additional withdrawal. If you're close to zero basis, switch to loans instead of risking a taxable sliver. Ninth, changing ownership or beneficiaries without checking transfer for value rules. Gifting or selling a policy the wrong way can taint the death benefit. The fix: get advice before transfers. If you're considering a life settlement, keep the policy in force, use a licensed broker, and have your attorney and CPA confirm an exception applies or that you're comfortable with the consequence. 10th, relying on old illustrations and ignoring grace notices. One missed grace period with a loan can trigger a taxable lapse. The fix: redundancy. Opt into paper, email, and text. Add a trusted contact who receives duplicate lapse notices. If you travel or have health issues, set a small automatic premium draft as a backstop to cover minimum required amounts during grace windows. 11th, waiting until December to act without modeling. Year-end surrenders bunch income. The fix: run a December versus January comparison with your CPA. 1 page, 2 scenarios, including IRMAA tiers. If deferral saves real dollars, wait, unless your policy is on the verge of lapse. Then stabilize first by paying the minimum to exit the grace period, and revisit timing once safe. 12th, ignoring state tax. A modest state rate on a big gain is still real money. The fix: include your state's rules in the projection, and, if possible, coordinate timing with any plan moves or residency changes that are legitimate and already on your roadmap. Your quick win: pick the 2 mistakes you're most exposed to, usually Lapse-With-Loan and IRMAA, and set fixes today. request basis and MEC letters, enable multi-channel lapse alerts, and book a 20-minute IRMAA modeling call with your CPA. Small moves now prevent big tax bills later. Implementation checklist and timeline. Let's turn this into a simple, time-boxed plan you can follow without getting buried in paperwork. We'll use a 30, 60, 90-day sprint, then a short annual rhythm. Keep everything in one folder and move in order. Day 1 to 30, gather and verify. Call the insurer and request a basis confirmation letter, full transaction history, current in-force illustration under 3 scenarios, current, conservative crediting, higher loan rate, MEC status letter, surrender charge schedule, and current loan balance with accrued interest and loan rate. If the policy ever moved companies, ask prior carriers for transaction histories covering their periods. Start a 1-page policy profile. Owner, insured, primary and contingent beneficiaries, basis to date, cash value, loan balance, MEC status, rider summary, and service contacts. Build your spreadsheet. Date, premiums, dividends, and how applied, withdrawals, loans, loan interest payments, face changes, and notes. Reconcile the insurer's basis to your spreadsheet. If they differ, flag the items to research in the next phase. If demutualization happened, add those letters and stock records to the folder, separate from the policy file, but indexed. Day 31 to 60. Model scenarios and choose your path. Send your folder to your CPA or EA. Ask for projections on 4 scenarios you're actually considering. Keep in streamline with withdraw to basis, then loans, full surrender, 1035 to low-cost annuity, 1035 to new life with LTC or chronic rider. Add a 5th if a life settlement is plausible. Have the model federal, state, Social Security taxation effects, and a 2-year IRMAA projection for each, including December versus January timing if relevant. In parallel, ask a fee-only fiduciary to sequence withdrawals across accounts and test policy sustainability under conservative assumptions. You want guardrails, target loan-to-value, minimum cash buffer, and actions if projected lapse moves inside life expectancy. If you're exploring 1035 options, have a licensed insurance pro produce side-by-side ledgers, confirm MEC implications, and detail surrender schedules and rider terms. If there's a loan, request written handling options for any exchange. If legacy or Medicaid planning is in play, book a short meeting with an estate or elder law attorney to review incidents of ownership, beneficiary language, ILIT considerations, and look-back issues. Day 61 to 90. Execute and verify. Pick one plan. If you're keeping the policy, submit a partial surrender request capped to your remaining basis in writing, then set up small quarterly loans. If you're reducing costs, process a face reduction or elect reduced paid up as shown on your illustration. Enable automatic bank drafts for premiums and loan interest. If you're exchanging, complete a direct 1035, insurer to insurer. Do not touch the money. If a loan exists, follow the carrier documented path you selected. After the new contract issues, verify basis carryover and MEC status on the first statement. If you're selling, keep the policy in force during bidding, collect multiple meta fee offers, and have your CPA confirm after-tax results versus surrender or 1035. Execute transfer paperwork only after confirming transfer for value exceptions or accepting consequences. Update beneficiary forms now. Primary and contingent, per stirpes or per capita as intended. Get written confirmations. Set up alerts, email, text, and paper lapse notices. Calendar an annual illustration review. Add a trusted contact to receive duplicate notices. Annual maintenance, 60 minutes once a year. Pull a fresh in-force illustration with current, conservative, and higher loan rate scenarios. Confirm projected lapse age, required premium to age 95 or 100, and death benefit trend. Reconcile 3 numbers: insurer basis, your spreadsheet basis, and insurer's projected taxable gain on surrender. Fix mismatches while memories and records are fresh. Recheck MEC status after any material change. Confirm loan balance, loan rate, credited rate, and loan to value. Review IRMAA tiers for the coming year and your projected MAGI. If close to a threshold, adjust withdrawals or loan usage before year end. Reconfirm beneficiaries and addresses. File a beneficiary confirmation with the insurer if anything changed. If care is on the horizon, pre-qualify rider claims or request a 1035 packet for hybrid options. Keep those ready so you can move fast without triggering tax. Now you try, pick one tiny action today. Call the insurer for a basis letter and Unforced illustration. Or email your CPA asking for a 2-scenario tax and IRMAA model. One call sets the rest in motion. Then share this with a friend who owns cash value life insurance, so they don't get hit with a surprise 1099. The key takeaway: policy gains become ordinary income fast if you cross basis or lapse with a loan, but a plan lets you access value or exit without handing 30% to taxes. Do this now. Run your quick math. Confirm MEC status and basis in writing, and request your Unforced illustration before making any move. Then, share this with the one person you know who owns life insurance. They'll thank you later. Subscribe for the MEC Deep Dive. And watch my IRMAA Stacking Traps video next so your Medicare premiums don't jump 2 years from now.